Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here with Chris Bates, the number one mortgage broker in Australia. Batesy, how's it going?
I'm doing all right, Pete, but I wish I was you right now. Over in Kuala Lumpur and getting a bit of your travel bug time in. We're desperate for a bit of an adventure, to be honest, our family. So a little bit jealous if I'm honest right now. I actually want to be on a plane somewhere and having a bit of different food and different experiences. And so how's it going?
It's funny, the internet in Kuala Lumpur is actually better than it is on the Sunshine Coast. I'm not sure what to read into that, but I'm actually recording in my board shorts here. You'll be pleased to hear. So I've been over in Malaysia this week. I've been to Penang and Georgetown and in Kuala Lumpur. It's a fascinating place, and you can just see how quickly it's developed. It's probably a dozen years since I was in Georgetown and KL properly, and you can see the Chinese development and the rate of change is amazing. So it's pretty interesting. It's also very humid, I should say, so it's not for everybody. But it's a popular place to come because, of course, it's relatively cheap compared to most big Asian cities, and you can see a fairly big sort of thriving expat community and a lot of other stuff going on. So what have I missed in Australia this week?
Oh, I mean, obviously the RBA didn't cut rates. That was some pretty big news, but I think everyone here is exhausted. I've spoken to quite a few clients. Some clients have been made redundant as well, and a few clients that have had to put things on hold, and some that are just a bit over not having good choice, but they're absolutely ready to go for next year. So it's a bit of a quieter stage. I think everyone's just sort of battling on way through to Christmas, but not cutting rates. But I would say the commentary was pretty positive compared to what we've seen. I mean, what was your take reading the RBA notes?
Yeah, I mean, I'm sort of following on my phone a little bit in between visits to the pool. But I saw that, the NAB business survey was particularly weak for November. Business confidence slumped into negative territory. Business conditions were weak. Price pressures have kind of eased a bit. And I think if you look at the Reserve Bank, yes, on hold as expected, but the tone of the statement and particularly the media conference, which I did listen back to after the event, it seemed a lot more relaxed about inflationary pressures and probably more turning towards some of the risks, I suppose, for 2025 as unemployment goes up. And actually, if you look at market pricing, it was moved on the day. I think if you look at index swaps, if you take it at face value, February is priced as kind of a 2 in 3 chance of a cut. I'm not really sure about that. I think you would need to see a particularly soft inflation figure for the final quarter of the year and probably deteriorating employment figures. But if you were to look out towards, say, May, for example, 2 cuts are priced in. So I think the tone of the commentary has definitely changed more. I think previously people were talking about, will we have further tightening? Now it's, what's the timing of the first cut? And also, I think beyond that, how many cuts do we get in the cycle? If you look out to, for example, July, pricing's for about 3.75%. So maybe we don't get that many cuts in the cycle. Maybe it's only back to a kind of a neutral rate of 3.5. So I guess you could say that's still a higher interest rate than we had in the pre-pandemic years. So it's interesting times, isn't it? But certainly a change of tone, I think.
Well, it's jumped from a 40% chance of a rate decrease to and actually more than 2 and 3 now, Peter. It's actually jumped to 84% overnight as well on the ASX tracker.
Too much time in the pool and not enough time looking at markets.
That's right, mate. But also these things have changed so many times over the last few years. I don't even know why I didn't look at them. But obviously sentiment is tied to where rate expectations are, and I think there is when that first one does happen, it will be a bit of a sugar hit for buyers to want to get ahead of the herd, and similar to what we saw in September time this year. And so, it's pretty much shut down now for the next 4 to 6 weeks. And so a lot of can change in that period as well. What's some of the big data points you're looking at over the next couple of months, do you think, that will factor into the next decision?
Oh, for interest rates, I think Q4 inflation is the big one, which isn't actually released until February. But I think, I mean, what a lot of people have been saying is, yes, the headline rate of inflation is back to target. But if you look at the trimmed mean inflation, which basically strips out some of the outlying data points, in particular, inflation has been pushed lower by electricity subsidies. Well, yeah, that's still above target. But I think if we got a soft figure for inflation, let's say 0.6% or below, then that would probably trigger a change of stance. I think the other thing is unemployment. One of our stories this week that we're going to talk about shortly is how labour markets are deteriorating in some other countries. If you look at UK, Canada in particular, New Zealand, unemployment is now rising. In Australia, for various reasons, that hasn't happened yet. But if there's signs of the labour market being less tight, I think if the unemployment rate starts to rise away from 4% towards the mid fours, well, obviously that would be a concern as well. So those are probably the two big ones. There's other bits and pieces as well, of course. I think it was interesting to see. It was probably the final big auction weekend of the year, and particularly for Sydney, the auction clearance rates have just dropped away markedly towards the end of the year. The property market in Sydney and Melbourne seems to have run out of gas completely for 2024. I mean, that won't hurt either, I suppose, from the Reserve Bank's perspective.
Yeah.
And I think as well, rents, a lot of people would have seen over recent months, all of that rapid rental price inflation has gone away as well.
Yeah, I don't know about you, Pete, but I think, Australians are also running pretty tight on their cash flow, right? And I think that coming into Christmas, I can't see there being anything really confident, like you said there about the NAB business survey. So I don't think people are going to be out there spending lots and lots of money and getting extravagant over the Christmas period, which is probably good news for our inflation. I mean, arguably we want our unemployment rate. I know people are going to lose their jobs, but ultimately from a macro level, we probably want the unemployment rate to sort of be slightly going up, just not as drastic as it's happening in places like Canada. Is that sort of your take?
Well, probably, yes. I mean, there's a big debate about where is the Nauru figure at which inflation is not accelerating. I think, if you went back years ago, people used to say, well, kind of a 5% unemployment rate might be the sort of a balanced market, if you like. It does seem to be now that figure is probably quite a lot lower for various reasons, probably more part-time jobs, for example. You could certainly say, even with the unemployment rate at 4.1%, well, wage price pressures have just gone away. So maybe that sort of natural non-accelerating unemployment rate is actually probably quite a bit lower than we previously thought. It's a bit like trying to predict where the horizon is, because the nearer you get to those figures, it always kind of seems to shift around a bit, and it's not something you can directly observe. But it does seem that maybe if we get an unemployment rate rising from here, then the market's just not that tight anymore. It's definitely a change. If you went back a couple of years ago, there was just a massive shortage of staff for cafes, restaurants, retail. Well, that's not the case anymore. I think those positions have by and large been taken up. And just today, job vacancies figures, they're down about 14% from a year ago on the government's jobs and skills figures. So I think some of those pressures are probably going away already.
Yeah, so we crack on with story number one, Pete, around what's happening in Canada. It's I'm not too close to this, but it seems like there's some tough times happening over there.
Yeah, I mean, it's an interesting one. I think one of the reasons that people like to look at America is it tends to lead the world in a lot of ways. And I think from a political perspective, you get changes of government and policy over there. And then later on, you see them reflected in the UK and Australia and New Zealand. Certainly, the current government in Australia has been almost copy-pasting some of the policy moves from the US and other parts of the world. So, I was just looking at the unemployment rate figures for Canada, 6.8%. That's the worst since 2017 if you take out the COVID spike. So it's interesting because it's kind of a mirror image of Australia in a lot of ways. Massive immigration in Canada over recent years under the progressive government. Jobs growth has actually been quite solid, and yet suddenly we've got an unemployment rate of nearly 7%, which is alarming. And I will see a change of government there. And I think it just seems as though the Reserve or the Bank of Canada, I should say, is now just behind the curve and will be cutting interest rates quite urgently, probably another 50 basis points next month. New Zealand, obviously our nearest neighbour, not quite so bad, but still also, I think, struggling. The unemployment rate there is up to 4.8% and clearly trending higher from here. So I suppose that's the thing for Australia is to watch out for. Is there a risk that we end up in the same situation? Because we do have a high rate of immigration. We've probably skirted the risk so far because we've seen a lot of public sector and government jobs. But I mean, I don't know. What do you think? Whether there's a potential risk of Australia ending up behind the curve as well because we're following in similar trends?
Yeah, I mean, that's you listen to the Steve the Kook, right? He's been, saying, cut, 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 cut. This is a car crash. We're going to cut too late. I mean, do you think that, watching countries around the world and maybe they have potentially cut a little bit too late and no one wants to see unemployment consistently going up to quite, levels that create a lot of fear, right? And then employers don't hire, etc. So, and it just starts getting worse and worse, a spiraling effect. Do you think the RBA is going to look at that and want to try to cut earlier now just to avoid this once they know that inflation's back in the bottle?
Yeah, I do. I do have some sympathy. I suppose being a kind of effectively a quasi government role, and you probably stand to get some criticism. But it does seem to be very tribal. Whatever the RBA does, people say, well, they left interest rates too high or too low, and people are never happy, I guess. And it is very tribal as well. It does seem that the Labour-aligned commentators are urgently calling for interest rate cuts ahead of the election. Other people are saying, but how can the Reserve Bank cut when trimmed mean inflation is still 3.5%? So I suppose there's two sides to the argument. Definitely, there'll be a concern that if the RBA leaves it too late, then what happens if unemployment starts getting away from them and it takes time for those interest rate cuts to flow through? So it's a very tricky balancing act for sure. Chris, this is just kind of a related question. I've been, for better or worse, I've been on social media now for way too long, and I'm probably too online, if you like. And probably the question or the statement that people make to me more than almost any other, it seems, over the past, say, 15 years or so, is that, well, in the US, there was a housing bubble in 2006 and it crashed. And therefore, Australia, it has to happen here because 17 years ago or whatever, this happened in Spain and US, and therefore it must happen in Australia. But just interested to get your take on that because I've kind of stopped responding to it because I've run out of things to say really after 17 years. But do you think there's any merit in that argument that there's been a housing bust in Spain and Ireland in particular in 2006-07? Do you think there's any risk of something similar playing out in Australia?
Oh, look, I think it's had some pretty big tests over the last, 5-10 years, and none bigger than the last 2 years, I would say. Rates going from 2 to 6.5% in a couple of years, borrowing capacity is falling 30-40%. And I think what we started to learn more and more is that it's not just that 1 + 1 = 2. There's a lot of complexity within the property market, and it's not so much always about impact to demand. It's also how does it affect supply and how does it affect people owning homes. And even though times are tough, it doesn't mean that everyone's forced to sell. And I think people are getting more and more understanding that it's not every property is owned by someone who's leveraged up, who's running it really tight with no access to any money. And I think the other thing we're starting to realize is that we're living in our houses longer and longer, and the amount of intergenerational positive equity within the property market is getting passed down. And absolutely, another issue that we're having now is there's not really an oversupply problem. In a lot of those other downturns, it was building way more than people needed, but we've been underbuilding for so long. So if anything, we're chronically undersupplied now of particularly things that suit couples and families. And so I would say, if everyone packed up a bag and left Australia, right? And our housing needs or the demand for housing was much longer structurally, and that was reducing because we had an aging population problem and no one was moving here, and etc. And on top of that, we were overbuilding. Then you could argue and say, well, the demand and supply doesn't equal current prices. But if anything, supply is actually getting tighter and tighter every year. I think once you start to really unpick turnover rates and see that, people are yes, they'd love a bigger house, but they can't afford to make those jumps. So they're staying in this house, and that's going to be a house they live in for 10, 20 years. The transactions of properties are reducing each year. And I think that that's tightening supply more and more, because every year the marginal buyer theory is that, as long as you got enough buyers willing to pay current prices, and so yeah, supply's tightening up, and I do think we're getting lots of issues out of the property market, but that doesn't mean prices are going to fall. Inequality and less and less home ownership, etc. But the fundamentals aren't really there, I believe. And I think the one thing that could have caused that was a huge impact to borrowing capacity and interest rates. And you can see what's happened over the last 2 years is, yeah, absolutely, people are struggling, but it's not the mass part of the market that are forced to bail. A lot of people drive around and think, oh, if rates go, everyone's running it really tight. And if rates go up, everyone's going to have to sell. That's kind of been proven the last 2 years. That's not the case.
It's pretty interesting, isn't it? We went through that Banking Royal Commission in 2019, and there was a massive credit squeeze then, because banks were very fearful of lending really for anything that was non-standard. And yet, I look at 2024. The US stock market is probably going to finish the year delivering 30% total return. Aussie stocks maybe not quite so much, but still a massive year for stock market wealth. Superannuation balances record highs. Housing values 11 trillion. I think Australian household wealth will finish the year at maybe up 10% or 17 trillion or so. I think the one thing that the housing sort of perma bears have ended up getting wrong is that there was a lot of talk around every year really, but particularly in 2019 about unsustainable prices. But I was reading Michael Matusik's blog this morning. If you look since then, it's nearly we're kind of 4 years on now from the pandemic. The cost of construction is up nearly 50% now, and that's a permanent increase. Prices are never going back for construction. If you look through the history of the construction cost index, we've probably got 60 years of stats there, because labor costs go up and generally materials costs as well over time. Those construction costs are never going back to where they were in 2019. So yes, there's ups and downs through the cycles, but we're not going back to those 2019 days when you could construct a house for 50% lower prices. So yeah, I think it's there's always going to be tests for the market, and as we've seen, the different cities have different cycles, and there's definitely been numerous downturns since 2007, but pretty resilient overall. Let's have a look at this second story of the week. This is going back a little bit, but GDP growth for Australia, the national accounts, very disappointing again. I think we actually talked about this last week and said it looked like it was going to be a weak one. 0.3% growth. So that's now the seventh quarter in a row where things have gone backwards in per capita terms. I don't think we've ever done that before, have we? It's a very drawn out per capita recession. Households generally seem to be now saving rather than spending their tax cuts, probably building up some buffers. Interest payments on houses, as we know, are taking a big chunk of money out of the economy. So, it does seem as though the rate hikes have done their job. And if you looked at this sort of implied price deflators in the national accounts, if you don't want to get too jargon heavy, but they were pretty low. So it seems like it's just kind of more of the same in terms of the national economy. But I guess with the price of everything in Australia having gone up quite significantly over recent years, I think households per capita anyway, just cutting back on their spending generally.
Oh, and I think the pain's still got years to come, right? Even if there is some rate cuts next year, households, particularly younger households who thought they had a pretty good, on low interest rates, and they leveraged up in 2020, 2021, and and they did have big mortgages. They've had it really tough the last few years, and they've got no buffers, and they're absolutely trying to rebuild all their buffers, right? And so I don't think their spending's going to pick up even as rate cuts happen. I think they're going to be trying to really get on top of their mortgages, try to build up buffers again. And on that point, the older generation, they're probably just happy. They've had a great time the last few years, particularly ones without mortgages who've got money in shares and stocks and just even money in the banks. ING will give you 5.5% right now just on money in the bank. It's crazy. They've had it pretty good, mate. Are they going to change their spending? Probably not. They just enjoy their life too much. So when rates come back down, I don't think they're going to change their spending. But I do see times it's still going to be really tough for everyone with mortgages. They're going to really want to get on top of rates, even if they have got a small mortgage compared to the value of their house, and even a multiple of income. It still looks not a huge mortgage. People just hate paying, interest at higher rates, and they're going to consider current rates quite high. And so there's still going to be a desire to get on top of the mortgage. And if they felt any pain over the last couple of years, they're going to be like, well, I want to get on top of my mortgage so I don't have to, if rates do stay high for longer, it's not going to be that painful. So, I mean, that's my take on the current snapshot with where rates are. Is that aligned with you, Pete, or are you thinking a bit different?
No, I think so. And I think the really pleasant thing about being in Malaysia this week, you would know this because you've got kids. You go out in Australia now, especially around Noosa and places like that. You go out for breakfast and you're almost head in hands because the bill's going to be $100 before you've even started. A couple of drinks, couple of juices, and a breakfast each, and everything's just expensive now for eating out, for shopping, groceries. It's interesting coming over to Malaysia because it's almost like things used to be. In Australia, you say to the kid, have a coconut juice, have a couple of drinks, whatever, because the bill's not going to absolutely kill you at the end of the process. And I think that's why it's been such a difficult time to be an incumbent government at the moment, is that every single household feels that. Even the baby boomers would notice that things are more expensive when they go out and about. Just getting your basic shopping and food, and cost of fuel has been higher and everything really. So I think the interest rates are definitely doing their job and are probably now peaked. I think households are now crying out for some assistance come 2025.
Well, I mean, you made some good points there around inflation, Pete, and the building costs. I mean, that's going to get factored into property prices, right? So I don't think we've seen the value of buildings rate 50% higher, but ultimately the cost of build has gone up that much. And so I think there's the prices have to rise due to now the cost of land plus the cost of build is more expensive, right?
I think for units. For sure. If you look at Brisbane, unit prices have really shot up the last 3 years in particular, but not so much. If you look at Melbourne, in particular Melbourne, but also to some degree Sydney, I don't think since 2017, I don't think there's been much price movement at all. So in that context, maybe not that surprising that approvals are just so low. I think maybe Melbourne will get a bit of a spurt of building because of the cuts to stamp duty, but Sydney, it just looks like the supply is really struggling because it's just not that profitable for a developer to get a project out of the ground right now. And there's probably better things to be doing anyway in infrastructure or mining. I think you're right. I think maybe it's not so much the case if you looked at Perth or Brisbane because unit prices have gone up, but particularly Melbourne and Sydney. Yeah, it's just not that attractive for a developer to be getting into the space right now.
Yeah, and I think there's the inflation into building prices. There's inflation into wage growth, right? And and the debt is not what it was, say, 3 years ago. So a $2 million mortgage, for example, is not a $2 million mortgage in, say, a couple of years' time, particularly as rates start to fall. And so, I do think that people who have been able to hold debt over this period is that it still feels like a big number, but it's not as big as it was, say, 5 years ago based on, current wages and the people who potentially are looking to the wage growth in the area that you actually own a property. What's your take on that and debt sort of getting inflated away over time?
Yeah, if you look at household debt to income, that's one of the key arguments because in the US, obviously, household debt to income ratios decreased a lot from 2007 onwards. The housing market's come roaring back, mind you. But in Australia and Canada, debt to income ratios are still pretty high. It's about 1.8 times debt to disposable income in Australia. So across the whole of the country, debt levels are quite elevated. I think mortgage debt's about it's closing in on 2.5 trillion. Housing market's valued at 11 trillion. So you could say not that leveraged if you look at it in that context, but it's still a lot of debt, per person. So yeah, I think the one thing that is less well understood internationally is that Australia is quite unique. We don't see this in the UK, for example, in that we use offset accounts and mortgage prepayments to build up these big buffers. So if you actually to net off those buffer figures, well, debt to income ratios haven't really gone anywhere for 15 years. But yeah, I think it's still, yeah, I mean, it's one of the reasons that properties are popular asset class, because you can borrow quite a lot of money to invest. And yeah, $1 million mortgage today, well, in 25 years' time, it will probably feel like maybe 400 or 500. So the debt effectively gets inflated away over time, and that's definitely what's been happening since 2020.
Yeah, absolutely. Should we go to some maybe trends for 2025? I mean, is that time of year where people like to make some calls? I don't really like playing this game myself personally, but I don't mind picking a piece as what other people say. What's going around?
Yeah, it's easy to sit on the sidelines and throw a few stones. Well, let's look at yeah. Ray White put out their 2025 predictions. So, big fan of Nerida Conisbee, Ray White. So, they made sort of 10 predictions for 2025, some of which we've already talked about. So, for example, rate cuts in 2025 will bring buyers back. Runaway price growth in Brisbane and Perth to slow down a bit, which kind of does make sense given what's gone before. Some of the sort of hotspots or markets to watch: Sunshine Coast and the hinterland. And a bit of a shake-up in some of the premium markets. I think Gold Coast has been a surprise. It's always been popular on a cyclical basis, but it does seem to have attracted more people since the working from home boom has taken off. So I think a bit of a reshuffle in the luxury market. Obviously, Sydney will always top the tree. Probably that will never change. But Gold Coast is kind of joined the Sunshine Coast in that sort of big 2 million plus club. And then maybe a few different changes in commercial trends. But are there any sort of standouts from that report for you?
Look, I do think it's interesting when they start picking regions around the country and that are going to perform better than others. And, Ray White do have access to some amazing data, and they can see where, not which people are looking, but also where listings are. And so I agree that I think the Gold Coast is becoming more and more like a Sunshine Coast and up there with Brisbane. So I think it doesn't surprise me that's going to continue to perform quite well. And I think that people are going to be stuck to the cities. I think that this return to work is got a bit of way, particularly in a higher interest rate sticking around and job prospects not being as good as say they were. I think talent's going to be still stuck to the city. I think it's maybe a few years away till the market and confidence returns and then talent say, hang on a sec, I really want to buy a home, and you're going to have to offer me remote work or, very flexible hybrid work. I mean, what's your take reading the report? Anything else for you?
Yeah, I think I tend to agree. It does seem, I saw that Elon Musk missive resurfaced this week about demanding everybody's back in the office full time or they can leave Tesla. But yeah, I think in Australia, certainly the banks are keen to get people back into the office as times get a bit tougher for business. Well, Ray White basically said there's three key factors for 2025 that would prevent any significant drop in prices. Strong population growth that we've talked about. Secondly, building costs remain high, which we've also talked about, pushing more buyers into existing homes and helping to support prices in established suburbs. The lack of new supply means that this is a quote, any excess demand can't easily be met with new housing. And then thirdly, expected interest rate cuts could give the market a boost, particularly in the more expensive cities like Sydney and Melbourne. So summing up, the outlook suggests a period of modest price growth rather than significant fall. So it's interesting when you look around the traps. Canberra has struggled a bit of late in Melbourne, and while some of the other cities have done really well. A couple of other sort of trends, I think maybe a bit of a comeback for retail property, which has been a mixed market for some time with, I guess, the shift to online retail. And but just an ongoing struggle, I think, for the secondary office market. I mean, I've been talking about this for ages. I'm actually thinking about dipping my toe in and buying a second-hand office in 2025. So I might have to put my money where my mouth is, because I just think, there's been a big shift towards the A-grade stock. But some of those secondary offices, people are just not that keen on now. So there might be an opportunity to pick up a bargain there, maybe.
Yeah, potentially, P. I'm not sure I'd quickly rush there if I were
Falling
you.
knife.
But anyway, we can have a chat about that another day. But enjoy your time over in Malaysia. We'll have another chat. I'm not going to be around next week for 2 cents, but I think we're going to pick this back up in January and the new year. And wish
Yeah, it might
everyone
be
a happy
me on my
Christmas.
I think it's me on my Pat Malone next week. So you'll have to listen to me having a bit of a monologue. But yeah, we'll definitely be back on deck in early January. So in the meantime, if you want to have a chat about all things mortgages, you can always get in contact with Chris in the link in the show notes. Don't forget the Rask community forum as well, community.rask.com.au. Come and join the chat over there. And I'm Pete Wargent for your property advisory from Alan Wargent Property Buyers. So any weekend plans, Chris?
No, we're actually leaving on Saturdays. So my wife hasn't told me where we're going. So she's booked something for my birthday for a few nights. Then we're going to Malakuta for a few nights, then Melbourne, and then the Great Ocean Road. So yeah, absolutely die for the break. And yeah, looking forward to it.
The boots on the other foot. I'll probably be on a 14-hour flight from KUL to London Heathrow. So hopefully without screaming kids in the back, I might have to drug them. So yeah, have a brilliant time down in Malakuta and look forward to catching up when we next speak.
Talk soon. Thanks, everybody.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.